Everyone to the 29th Annual Baron Investment Conference. My name's David Judice, and I head up the Intermediary Sales and National Accounts team at Baron. We're going to keep this moving with my colleagues here on the panel. We're very excited. Want to thank you for coming. Thank you for investing with us, of course. And it's going to be a great day. So not going to waste any more time here and just ask my colleagues to say a quick introduction before we get started.
Hi, everyone. I'm Neal Kaufman. I manage the Baron Healthcare Fund. I've been at Baron since 2005.
Jeff Kolitch, manager of the Baron Real Estate Fund and the Baron Real Estate Income Fund. Also been with Baron Capital 17 years, joined in 2005.
Hi, I'm Josh Saltman. I'm manager of Baron FinTech Fund, and I've been at Baron for 11 years.
Great. So with that, I think we're going to kick it off. We have a really interesting panel today. We're going to cover healthcare, real estate, and fintech, so three interesting areas. I'm going to ask Jeff, if you could, get us started. A lot going on in real estate, very interesting space. Could you give us a little bit of your thoughts on that?
Sure. First of all, great to be back. It's been 3 years. Great to see everyone. Thank you. We didn't even say anything yet, and you're clapping. Appreciate that. But let's jump right into it. So I have an ambitious agenda. I'm going to try to cover 4 topics in the next 7 to 8, 9 minutes. Just a brief recap on what's occurred year to date and how we're thinking about next year. I'm going to make the case for real estate, number 2. I'm going to talk a little bit about the real estate strategies here at Baron Capital, and I'll wrap up with areas of investment focus. So let's jump right into it. Number 1, so year to date, I don't need to tell anyone in the room it's been a super challenging year. There have been a tsunami of issues that have been weighing on the marketplace, and we won't rehash them now, but all investable assets have corrected this year, from equities to bonds to real estate to REITs to alternatives, et cetera. And if you think about the building blocks of return, it typically is growth plus dividends plus the change in the valuation multiple. Just for illustrative purposes, growth has been pretty good this year, call it 10% or so, and dividends 3%. So you put that together, you have a 13% return. But what's overwhelmed it this year is the correction in the valuation multiple. In real estate, we started the year at 25 times earnings, and now we're at 16 times or so, 15, 16 times. So that's a 35, 40% correction in the multiple, which has overwhelmed the growth in the dividends, hence you have negative returns. That's what's happened year to date. As we roll forward to next year, recognizing there may be more volatility or perhaps some more downside in the months ahead, we don't have a crystal ball into it, but as we think about things, we see a potential setup when we're talking to you 1 year from now, where perhaps it's a mirror image of what occurred in this year. And what we mean by that is, number 1, no question growth is going to slow in the months ahead. The Fed is very intent on what they're doing, and growth is slowing globally. And so maybe next year growth's flat, maybe it's down a bit. Okay, but what's going to offset that, in our opinion, is you'll continue to have dividends, and we see a real scenario as growth is slowing next year, inflation's going to begin to roll over, interest rates are going to come down a bit, credit spreads are going to come down a bit, and that 15, 16 multiple in real estate perhaps goes to 20 times. Let's call it a 25% appreciation in the multiple. The multiple in the dividends offsets the growth. We think 1 year from now, we're going to be talking about a scenario where the market and real estate is up. We'll see how that plays out in the next 12 months. That's number 1. 2, the case for real estate. Let me do the long term on what we have in front of us right now. The long-term case is compelling, and the long-term case is if you look at real estate over 20 years, 30 years, a long period of time, real estate has generated strong long-term returns. It offers over a long period of time diversification benefits relative to equities and bonds. And if you own well-located real estate in supply-constrained markets, it offers inflation protection characteristics, and that's a key focus for our real estate strategy. So the long-term case is compelling. But what do we have in front of us right now? Well, number 1 is real estate stocks have corrected a lot this year, as everyone knows. It's not been fun for anyone. So you have real estate stocks down 20, 30, 40, 50, 60%. That's number 1. Number 2, we are unearthing a lot of value in real estate. Forget about what we're telling you on stage right now. The largest real estate manager in the world just 2 weeks ago was on TV, John Gray, president of Blackstone. And what did he say? The question that was posed to him was, where are the best opportunities in real estate? And his response, the best opportunities in real estate are on the screen, meaning in the public market. There's an arbitrage between the public market and the private market, and we concur with that view of Blackstone. Number 3, markets tend to bottom just as we're heading into a recession. Markets tend to be anticipatory, or they're a discounting mechanism. And when the macro begins to roll over and when the micro begins to roll over, meaning the growth for these companies, very often what happens with that is the Fed moves away, interest rates start to come in, inflation starts to roll over, and some of the headwinds to returns that we talked about this year are going to reverse, and that's when the stock market typically takes off, and that's when real estate stocks historically have taken off. Number 4, very important. We study real estate cycles over decades. If you look over 10, 20, 30, 40 years, the curse of real estate over a long period of time is that following a period of strong growth, what happens? Excessive leverage is used. Real estate developers, individuals, companies take on too much debt. And when they take on the debt, what do? They build too much real estate. They build too many homes, they build too many office buildings, they build too many hotels, they build too many apartments. That's what happened in the 1980s. What happened in the 1990s? Major recession, occupancy goes down, rents go down. What happened in the global financial crisis? What happened in the housing crisis? Anyone could secure a mortgage. People were buying office buildings in New York City at 3% cap rates and taking on leverage where you had a negative spread, much more expensive leverage. What ended up happening? We had a housing crisis, we had a global financial crisis. The silver lining of what we have in front of us right now is for the real estate cycle and where we are, we're starting from a much better place relative to history. One, business fundamentals on commercials, pretty good at this stage. Occupancies, generally speaking, are at around mid-95%, but we've learned our lessons from prior decades. Number 1, if you look at companies, individuals, real estate developers, real estate landlords, balance sheets are in good shape. We haven't taken on too much leverage. Number 2, we're not overbuilt. Some of that in part due to what happened with COVID and supply chain bottlenecks and increases in labor, material, land costs. So we're starting from a much better position as it relates to the demand-supply or inventory relationship relative to other periods when the cycle started to roll over. Summed up, our view is when things begin to slow, if in fact we're in a recession in the year ahead, we believe it's going to be shallower than it has been in the past because we do not have the excesses that we've had in prior decades. Last comment I'd made is if you concur with us that the setup for real estate from where we are today is attractive on an absolute and relative basis, the one item we encourage you to do is go with an active manager, not a passive strategy. The real estate landscape has changed. If you buy an index passive strategy, an ETF, you own the good and the bad of real estate. You own everything. You're not discerning. The real estate landscape has changed where today there's a haves and a haves-not group. Do you really want to invest in office real estate over the next 5 to 10 years when there's going to be occupancy pressure and rent pressures in part due to the work from home dynamic? Our answer is no. Do you, over a long period of time, want to invest in retail real estate such as malls and shopping centers, where there are more malls and shopping centers in this country on a per capita basis than anywhere in the world, and more people are buying online and not going to the mall? Our answer is no. You have to be cognizant of the business traveler in the world of Zoom and perhaps business travel and the impact on hotels. So finding an active manager that can be more discerning on a long period of time, we think is very important for real estate. Number 3, just 1 minute on Baron Capital and real estate. What I would say is our firm we've been in business for 40 years. Our firm has a long history of investing in real estate since our inception 40 years ago. Investing in real estate is a natural extension of the investment philosophy that we pursue across all of our strategies at Baron Capital, which is long-term investing in competitively advantaged companies, and the competitively advantaged companies tend to grow a bit faster than the peer group. That's the philosophy for Baron Real Estate. We have 2 products. We have a Baron Real Estate Income Fund, which our team has been managing for the last 5 years. It's more analogous to a traditional REIT-oriented, dividend yield-focused fund. And we have a highly complementary product that we've also been managing now for, it'll be 13 years at the end of this year, which is the Baron Real Estate Fund, which is not a REIT fund, it's a real estate-related fund. It invests in REITs, but takes a broader, more all-inclusive approach and also invests in real estate C-corps, operating companies, commercial real estate, residential real estate. It's a more all-inclusive, broader approach to investing in real estate. It has, in effect, a larger addressable investment universe. We pursued that because our view is over the long term, that type of strategy that looks at real estate more holistically should outperform a more narrowly defined REIT-only type of strategy over the long term. We're often asked which product is superior. Our view is one isn't necessarily superior to the other. It really depends on what your investment goals are. Is it to maximize returns? Is it you're seeking dividend yield? Is it you're seeking diversification relative to equities and bonds? Are you seeking less volatility in the performance of the product over a long period of time? In a nutshell, the Baron Real Estate Fund, the real estate-related fund, is more equity-like and growth-oriented in nature. Equities over the long term outperform bonds. The Baron Real Estate strategy over the long term should outperform a more REIT-like type of strategy. The Baron Real Estate Income product, which is quasi-equity, quasi-bond with dividend yield as a principal investment objective, should over the long term have a bit less volatility and some more diversification benefits. Last comment. So where do we see opportunities? This is what we really enjoy talking about, is where are the opportunities to generate returns over a long period of time? And there's a lot that we're leaning into in real estate right now, and I'll leave you with 4 thoughts. Number 1, REITs. We're bullish on REITs as we look out into next year. So why is that? Well, number 1, REITs have corrected quite a bit this year. Many are down 25, 30, 35, 40%, and we think valuations are compelling. But what you also have is growth is rolling over in the global economy for many of these companies, is strong visibility on the cash flow. Why? Because we have contracted cash flows, we have well-covered dividends, we have terrific balance sheets with staggered debt maturities, and should growth begin to roll over next year, and in turn, perhaps interest rates peak and roll over a bit and credit spreads begin to come in, dividend yield type of product should perform well. We think the setup for REITs as we look out over the next 12 to 24 months is quite strong. That's REITs. 2, the housing market. Been a long-term focus for Baron Capital broadly and for the Baron Real Estate strategy. In a nutshell, we're bearish on housing fundamentals. I think everyone knows why. But we're incrementally bullish on the housing stocks. So why is that? 1, everyone knows we're inundated every day, and I saw it on CNBC early this morning, all the headwinds to the housing market. In a nutshell, if you have home prices go up 30 to 40% in a matter of 2 to 3 years, and then you have mortgage rates this year go from 3 to 7%, guess what? You have sticker shock, and the would-be homebuyer moves to the sidelines and says, I'm pausing, let's let the housing market cool down, maybe we'll revisit this later. That's what's in front of us right now, but the stock market has already discounted that, and we're identifying a fair amount of opportunity right now in the stock market. Again, the stock market tends to be a discounting mechanism. These stocks rolled over way before the housing market started to correct this year. I'll leave you with one last thought on the housing market. Do not bet against the housing market long term. It simply comes down to everything for real estate is the economics of real estate, demand relative to supply. There has been a structural underinvestment in the housing market in this country that's gone on for 50 to 60 years. Okay? In 1950, we were building 1.5 million homes in this country at a time when we had 180 million people living in the US. Fast forward to today, we have 330 million people living in the US, 150 million more people, and we're building the same number of homes today that we were building in the 1950s. You have to shelter the population. How can that be? Guess what? Home prices are going up over the long term. They may not in the near term when you have a shock to the system like this, but ultimately housing prices are headed higher. Number 3, travel. Travel's a big focus. I know Ron has the CEO of Hyatt presenting, or I think was on TV earlier this morning. Baron Capital has a long history of investing in real estate-related travel companies, and it boils down to a secular phenomenon or mega trend that we focus on at Baron Capital, which is that we see a shift towards the prioritization towards experiences such as the prioritization of travel at the expense of spending on goods. We see that evolving. We've seen that evolving over the last several years, and now we think it's moving into a supercharged area of opportunity. That's a long-term focus for us. Notwithstanding, of course, we're aware of the near-term cyclical headwinds. The last is another bucket. We're long-term bullish on commercial real estate service firms. It's a highly fragmented industry. More and more companies are outsourcing their commercial real estate service needs, the institutionalization of commercial real estate. That's a subcategory of focus for us as well. We're focused on the real estate alternative asset managers. More and more capital is being allocated to alternative asset managers because of strong long-term returns, diversification benefits. That's an area of focus for us as well. And the digitalization of real estate, which we've written about and talked about. The intersection of technology and real estate is an emerging trend, and that's a key focus for us as well at Baron Capital. Let me stop there, see if there's anything else or questions.
Thanks, Jeff. No, that was very interesting. You mentioned a few different themes in like 1 minute or so, because we're short on time. I was going to ask if you could maybe cover a couple of companies, particularly that are attractively valued in your mind, whether it's REIT or travel-related, whatever you like.
Sure, and pull the hook if I go on too long. I have to leave time for my colleagues here, of course. So the punchline is high level. There's a lot that we like. We recognize that the market is in a period where perhaps it maybe goes lower ultimately before it goes higher. But as we think about real estate right now, we see an asymmetric return profile, meaning we're always focused on the downside versus upside or upside-downside relationship. And as a broad statement, with the correction that we've seen this year, as we look out over the next couple of years, we're underwriting companies at this stage where we're thinking about 10 to 15% downside, and we look at over the next 3 years, and we're underwriting many companies with conservative assumptions for growth and valuation multiples with 50 to 100% upside. So we like that relationship quite a bit. In REITs, a couple examples. We're bullish on single-family rental homes. Invitation Homes is the largest single-family rental company out there. Its real estate is valued at a little over $300,000 a home, but the liquidation value on their portfolio is around $450,000 a home. We have a wonderful data center company that reported yesterday, Equinix, which has secular growth, enduring growth, faster growth than REITs, but trades at effectively an inline multiple with the REIT index. We're long-term bullish on Prologis, which is the leading industrial warehouse REIT out there. You tell me another company that has contracted, embedded 50% visibility on its growth over the next few years, meaning its in-place leases are 50% below market rents. When the leases expire, there's a major markup opportunity. That's just on rates, 50% growth. Alexandria Real Estate, Joel Marcus, the CEO, is presenting today, the leading life science landlord out there. Here's the punchline. It's valued in the public market at $600 a foot right now, while we know they're selling their real estate at over $1,000 a foot. So it's effectively valued at 60 cents on the dollar. Home building companies right now, such as Lennar and Toll Brothers, you can buy them at or below book value, and we believe book value is safe. Okay, we've analyzed this very closely, where they purchased the land. The simple rule of thumb for home builders, if you could buy quality ones at around 1 times book value and sell them at 2 times book value, if you look over decades, that's the formula. Right now, they're at 1 times or below. Toll Brothers, Lennar, and others. Floor & Decor, perhaps the most exciting housing-related growth company that's out there. Right now, they just reported last night, highly discounted multiple. Travel-related, MGM Resorts, Red Rock Resorts, Vail Resorts, which is presenting today. I'll just leave you with Vail. This time last year, if you were in the audience, Vail stock was $370. Look at your screen right now or your iPhone. It's $215. Stock's corrected 40%. Trades at 11 times cash flow. Historically, it's traded at 15 times. No one's building ski resorts. Limited supply. They own the best ski resorts. Great pricing power. There's a lot out there that we like.
Great. Thanks, Jeff. A lot of good ideas there. And with 2 5-star funds, according to Morningstar's ratings, and top 1% in the 3, 5, 10-year time periods, impressive results with the real estate funds. So thank you, Jeff. I'm going to turn gears real quick. Neal, can we talk about healthcare? A lot of interest in the space, so maybe you can give us your thoughts.
Sure. So why invest in healthcare? Healthcare spending represents roughly 18% of GDP, and it's growing faster than GDP. The sector spans multiple sub-industries, many of which are not correlated with each other. So you can invest across the sector. You can invest in healthcare services, which might be negatively correlated with when medical cost inflation is low. You might have managed care companies that are generating very strong earnings. On the other hand, you have services companies that might be weaker. So there's this built-in diversification within the sector. There's very rapid legislative and regulatory change in the sector, so that creates opportunities. There's an incredible amount of innovation happening. And over the long term, the healthcare sector has outperformed the S&P 500 index. So what are some of the themes that we're investing in the healthcare fund at Baron? So we're very focused on secular growth. So the aging of the population and higher disease burden from chronic diseases. So for example, we have investments in medical device companies like Abbott Labs, Edwards Life Sciences, Intuitive Surgical, Inspire Medical. These are companies that sell devices for various diseases that should benefit from these long-term secular trends. There's a rising prevalence of diabetes and obesity in this country and worldwide. We have investments in Dexcom and Eli Lilly. Dexcom's the market leader in continuous glucose monitoring. Eli Lilly has a very strong franchise in diabetes and a drug that will launch next year for obesity that's fantastic and has shown in trials that could potentially help people lose their 20% or more of their body weight. We're investing in the applications that are emerging from DNA sequencing technology, such as oncology testing. So market-leading DNA sequencing company Illumina, which acquired Grail. It may have to divest Grail, but Grail is a company that offers a screening test for cancer. It's a blood test. You go to your doctor, you pay out of pocket something like $800 or $900, and it will screen for cancer, looking for cancer signatures in your blood, even if you have no symptoms. So this is a remarkable technology that is poised for growth over the long term. We think increases in biopharma R&D spending to discover and develop new drugs is an interesting space for life sciences tools companies like Bio-Techne and Thermo Fisher Scientific. We've seen the emergence of new therapeutic modalities like mRNA vaccine technology, and we also have investments in RNA interference companies like Alnylam and Arrowhead. On the healthcare services side, there's an increased adoption of Medicare Advantage over traditional Medicare. We have investments in Humana and United Healthcare, which are the market leaders in Medicare Advantage. And there's a shift in healthcare services from fee-for-service towards value-based healthcare, which means that reimbursement going forward is more tied to quality of care and outcomes over volume. So at Baron, we follow the approach of focusing on competitive advantage. So in healthcare, competitive advantage can mean analyzing clinical data or looking at reimbursement, having established reimbursement, or patents, or sales force or distribution advantages, or relationships with physicians. And so we do independent research, just like the other funds at Baron, and we take a long-term perspective. So why is now an interesting time to invest in healthcare? So healthcare offers defensive secular growth with inelastic demand. Healthcare this year has generally been outperforming the rest of the market because of these characteristics. There is an incredible amount of innovation in healthcare, and this is a growth area over the long term. In an inflationary environment, healthcare is a good place to be because many healthcare companies have pricing power, and I can give you numerous examples of that. Valuations are still very reasonable within the healthcare sector. So there's been this divergence between growth stocks and value stocks across the board. Within healthcare, you can invest in both. So our portfolio includes stocks that are sort of considered value stocks as well as growth stocks. And then on the political regulatory side, we're in a relatively benign environment there. We did see some drug pricing reform that was passed with the Inflation Reduction Act. We think the consequences of that are still to be determined. But in the near term, we don't see any significant risks. So overall, we think healthcare is an excellent place to invest.
Thank you, Neal. Great thoughts. And since, the April 18 inception, the fund's just about doubled the Morningstar average healthcare fund at 12.5% return. So very impressive. We're going to turn gears again in the last few minutes. We want you to hear the story on FinTech. It's the first time we're having Josh on the panel. So Josh, can you tell us about your fund and about FinTech, please?
Sure, Dave. So as a bit of background, Baron Capital has been investing in fintech for decades, going back to investments in the 1990s in CoStar and Charles Schwab, investments in the 2000s in Visa, MasterCard, and MSCI. So it's been a very fruitful area of investment for our generalist funds. And so about 3 years ago, we decided to launch the Baron FinTech Fund to provide our investors with concentrated exposure to this really attractive sector. So what exactly is fintech? It's a relatively newer term, but it refers to companies both new as well as companies that have been around for decades. We define it as the intersection of financial services and technology, where we see a tremendous amount of innovation taking place. On one side, we invest in technology companies that facilitate financial transactions. And then on the other side are financial companies, banks, insurers, asset managers, that we believe are using technology in particularly innovative ways to run more efficiently or to better serve the customer. So why is fintech interesting? Well, for one, it serves a huge addressable market. Financial services is the largest single industry in our economy. It represents 20% of GDP, and financial services companies represent $20 trillion globally of market cap. Financial companies spend more on technology than any other industry. It's about $600 billion globally. But despite all of this spending, the financial industry is really inefficient and ripe for disruption. It's dominated by large banks and insurance companies, many of which are decades or even hundreds of years old, and they rely on outdated systems. If you go to the back office of many large banks, you'll see mainframes and green screens. $18 trillion a year of consumer payments are still made with cash or check. Lending still relies on paper-based applications and incomplete data. And all of these inefficiencies lead to a poor customer experience. And that's why banks, large banks, have the lowest net promoter scores of almost any industry. But fintech companies are stepping in to solve these problems. Fintech companies are leading the transition to cashless payments. We own companies that help insurance companies and large banks modernize their IT systems and migrate to the cloud. We're investing in businesses that offer banking and brokerage services through your smartphone, so you don't have to walk into a branch. All of this leads to really attractive growth opportunities. Fintech, though, we think is especially well suited for active management. It's not well defined, it's not well understood. It cuts across multiple sectors, and we think that this complexity creates mispricings. Really requires expertise in both financial services and technology, and I think that's where Baron's expertise as a growth investor, as well as our experience of understanding balance sheets and understanding financial models, really helps us separate the winners from the losers. If you look at fintech over a decade plus, the sector has meaningfully outperformed the broader market. I think this has to do with the attractive financial profiles that we see, as well as the strong growth prospects. And so by investing in fintech, we think that we're really maximizing our opportunity set. So Baron FinTech Fund, we invest using the classic Baron criteria, looking for companies with strong growth, competitive advantages run by outstanding management teams that we can invest at a reasonable valuation. We take a multi-year time horizon, resulting in low turnover. We invest across all market caps, all geographies. Fintech is truly a global industry. Tremendous amount of innovations taking place overseas, and so we pay a lot of attention and are finding great opportunities overseas as well. The portfolio, though, is balanced between established businesses as well as more emerging companies, what we like to call winners and challengers. And in markets like this year, our winners have really served as ballast and helped to preserve capital, but we still expect a tremendous returns from our challengers over time. This is a high conviction portfolio, about 40 to 50 stocks at any given time, that looks very different from any other index or fund. So where we see opportunities ahead, right now we're seeing the best opportunities in fintech companies that benefit from higher rates. So a number of our businesses, such as brokerage firms or money transfer companies, they hold client cash that has been earning nothing for the past many years. Now that rates are up, companies like Charles Schwab and LPL Financial are earning higher yields on that uninvested client cash with high flow through to the bottom line. Our insurance companies that are very well positioned and do well even in a low rate environment, they're now able to invest in higher yielding fixed income securities. Some of our payment companies are inflation protected. They earn revenue based on the nominal amount of payment volume running through their rails. And so even if there's a shift from goods to services, even if real consumption is down, they benefit from higher inflation without commensurate increase in their costs. And lastly, we just see a tremendous amount of opportunity in very high quality companies that are facing temporary cyclical headwinds, but have very strong long-term growth prospects. If you look year to date, high quality companies have not performed well in this down market like they historically have done. And so we see a number of businesses such as rating agencies, credit bureaus, enterprise software companies whose long-term growth prospects are very strong, but we're now able to invest in much more attractive valuations. So in conclusion, very dynamic industry, lots of attractive investment opportunities, very well suited for active management. Fits very well with the classic Baron criteria, and this market pullback has created great opportunities to invest in fintech stocks at much more attractive valuations.
Great, thank you, Josh. And with that, we're going to have to conclude this panel. I want to thank the PMs and thank all of you. They will be outside the auditorium to take your questions because I know we didn't get to them, but a lot of good material. Thanks, guys.